Commerce Department revising second quarter GDP higher by 0.2%. And today's personal consumption expenditures data showing a 0.5% increase in consumer spending. Joining us now, we've got Gus Faucher, Chief Economist at PNC Financial Services Group, to discuss. And Gus, it's great to have you on here on this Friday afternoon. So we got a lot of economic data this week. We got jobless claims, PCE, obviously earnings painting a bit of a contradictory picture on the state of the consumer. What thesis about the health of the economy did you derive from the totality of that information this week?
We are seeing continued economic growth in the summer of 2024, but growth is slowing, and that's a good thing. And then we're also seeing inflation slow. So today's inflation numbers were quite good, and I think that means that the Fed can cut rates when they meet in September, and then cut rates multiple times in 2024 and 2025.
And when they cut in September, Gus, what are you looking for? Is it going to be the traditional 25, supersize 50? What would be your expectation?
Unless we get a really bad jobs report, I think we see a 25 basis point cut in the Fed funds rate in September. I think a 50 basis point cut would actually work against the economy because that would indicate that the Fed is concerned about growth. I think growth is still solid. We saw that in today's consumer spending numbers. So I think the Fed can gradually ease. The Fed does have the flexibility if the labor market weakens to cut more rapidly. But as of now, I think we see 25 basis point cuts every meeting for at least the next 6 months or so. That will support economic growth, and that will allow for a soft landing.
I want to talk to you about something that we heard from the Dollar General CEO and how that might be impacting the potential for a soft landing. The CEO saying in our latest survey, 25% of our customers surveyed noted they anticipated missing a bill payment in the next 6 months. And that's just one data point of a slew of issues that he cited about the health of the consumer here. Does it still hold to you that the lower income consumer can sometimes be kind of the first domino to fall in a string of issues with consumer spending? And is that something that could challenge the soft landing narrative, not for the next 6 months, but for some years to come here?
Oh, absolutely. I mean, obviously, higher income households are benefiting from rising stock values, rising house prices. So they're doing quite well. We're seeing the slowing in growth coming primarily from lower income and middle income consumers. They've been hit hard by higher inflation. That being said, when you look at aggregate consumer balance sheets, they're still in pretty good shape. Consumer debt burdens are low relative to incomes. And I think that generally consumers are in solid shape, with a little bit more concern among those lower and middle income households. But it is the upper income households that account for the bulk of consumer spending.
Gus, let's spin ahead to that payrolls report. I'm interested to get your forecast. What are you expecting to see there, Gus?
I think we see about 170,000 jobs added in August. I think we had some weakness in July, in part because of Hurricane Beryl, and we'll see a reversal there. I think we see the unemployment rate move 0.1 percentage point lower to 4.2%. And that would be a good, solid number consistent with slowing inflation and easing economic growth. And I think that allows the Fed for a 25 basis point rate cut. I think if the report is much worse than that, let's say we get flat jobs, increase in the unemployment rate, then maybe we see the Fed cut 50 basis points. But I think if we get something in line with expectations, that's what the Fed wants to see. And then we get that 0.25 percentage point cut on September 18th.
Gus, while we're on the subject of the labor market, I'm just curious to get your take on that big revision we saw, 818,000, Gus. I'm just curious to hear what you made of that, and also the role immigration played there, Gus. That was another question that was being asked.
Yeah, so obviously that was a much larger downward revision than we normally see. It was about 5 times larger than the typical revision. I think some of that is due to the more updated data not capturing some people who undocumented workers in the economy. I don't think it changes the story very much. I think we had a very strong labor market in 2023. We have seen job growth slow over the past year or so. And it perhaps is a little bit weaker than we thought prior to those revisions, but we still have a good job market, just not as good as it was last year. We still have a low unemployment rate, just not as low as it was last year. And I think the story is consistent with softening economic growth and something moving closer to trend, over the next couple of years.
That's exactly where I wanted to go. Are we seeing slowing that's a trend, or slowing that is potentially not so great to see? The labor force, taking a look at some stats here, the labor force is expected to grow by 0.4% per year for the next decade, according to BLS data that we got today. That's a third of the prior decade's gains. Is that a new normal, or is it a sign of slowing over the next decade that is potentially concerning?
No, that is concerning. I mean, obviously, we have the baby boomers retiring, and they're going to be leaving the workforce over the next decade or so. One way we can make that up is through higher immigration levels. It looks like, we're still not quite sure, but it looks like one of the factors supporting economic growth over the past couple of years has been higher immigration. But we need to think longer term about an aging workforce, where we're going to find workers, find ways to increase labor force participation among native-born Americans, but also figure out ways to bring more people into the economy, because they will be needed for long-run economic growth.